Did you know there was a 0% tax bracket for capital gains? And on top of that, there are people with 6-figure and 7-figure incomes and multi-millionaires that are qualifying for it? Well, there is. And all you have to do is earn a specific type of income and meet a few requirements. As a licensed CPA at mycpacoach.com, I have seen people save tens of thousands of dollars in taxes from this strategy alone. They simply take advantage of differences in tax rates for certain types of income. And I want to show you how it works, so let's jump right into it. All right, so the first step to achieve a 0% tax rate is to earn income that qualifies for it. Specifically, you need to earn income tax as long-term capital gains. A capital gain typically refers to an investment you sell for more than what you paid for it. And if you hold the investment for longer than 12 months, it qualifies as a long-term capital gain. And if you don't, then it will be taxed as ordinary income, which, by the way, is the most expensive type of tax you can pay, with rates up to 37%. And also keep in mind that certain dividends are also taxed as long-term capital gains, specifically qualified dividends. So if you earn qualified dividends or sell investments that you've held for at least 12 months at a gain, then it will be taxed as a long-term capital gain. Now, this single distinction opens the door to lower tax rates ranging from 0 to 20%. Now, let's talk about how you can qualify for the lowest rate possible. Let's start with the basics, and then I will explain how the wealthy are taking advantage of this. So on a basic level, as you can see here, your capital gains tax rate depends on your income. And to qualify for the 0% tax rate, you must report less than $47,000 in income as a single taxpayer or $94,000 as a married taxpayer. If the total income on your tax return is less than these amounts, then you would pay 0% tax on your capital gains. And if your income is greater than these amounts, then you would only pay capital gains tax on the amounts above the 0% threshold. For example, a married taxpayer with $104,000 in capital gains and no other income would pay 0% tax on the first $94,000 in capital gains and 15% on the next $10,000 as of 2024. But wait a minute here. At the beginning of this video, I told you that there were people with 6-figure incomes and multi-million-dollar net worths who are qualifying for the 0% tax rate as well. So how is this possible? Let's walk through the two most common scenarios where this is the case. Scenario 1, deducting down. So let's say you earn well beyond the rate to qualify for the 0% capital gains tax. Well, one thing you can do is take tax deductions that lowers your income down to the qualifying rate. Tax deductions directly reduce the amount of income that you report on your tax return. And we see a lot of people with high incomes that have so many tax deductions that they end up qualifying for the 0% capital gains rate. For example, hypothetically, if you earned $1 million in income, but had $999,000 in tax deductions, you would only report $1,000 in income, which means you would pay 0% tax on up to $45,000 to $90,000 of your capital gains, depending on your filing status in this scenario. This is how millionaires grow billions in wealth, earn millions in income, and pay almost 0% of it in taxes. They have so many tax deductions and losses on their return that it ends up wiping out a large part of their income. And you can accomplish the same thing by learning how to maximize your tax deductions based on your unique set of circumstances. Now, by default, everyone can take advantage of the standard deduction, which is about $14,000 for single taxpayers or $29,000 for married taxpayers. So someone who is married with $100,000 in income would only have about $71,000 in taxable income thanks to the standard deduction. Meaning, if they had $23,000 in capital gains, they would pay 0% tax on that amount. But the standard deduction is really just scratching the surface when it comes to tax deductions. There are ways to take tens of thousands, hundreds of thousands, and even millions of dollars in tax deductions. For example, Jeff Bezos was able to offset $46 million of income one year with various tax deductions. And you can too by taking advantage of key tax benefits that are already available for you in the tax code. You can create huge tax deductions through a small business or side gig, which grants you access to over 100 additional deductions. You can also do real estate investing, which allows you to write off a large amount of your property's cost every year through depreciation. Or you can take advantage of retirement and health savings accounts, which can grant you a tax deduction for every dollar you contribute to it up to the maximum limit. And those are just some of the heavy hitters, but there are far more out there, like charitable deduction strategies, C Corp strategies, and so much more. So make sure you're subscribed to learn more about that. But my main point here is that you can qualify for the 0% capital gains rate by taking deductions that lower your income to the qualifying rate. The capital gains rate is applied to your income after taking all of your tax deductions, so be sure to maximize this. Now let's move on to scenario number 2, timing your gains. Timing is everything when it comes to taxes. If you are earning $100, $200, $500, or even $1 million per year in income, why would you want to trigger capital gains tax when you do not have to? Especially when instead you can report the capital gain when your income is low, perhaps when you retire or in periods where you are not working or earning income. Remember, when it comes to capital gains, you only pay tax when you sell your investments, not when they rise in value. And because of this, a lot of savvy taxpayers implement a buy and hold investing strategy, which simply means they buy investments they intend to hold for long periods of times, even decades. This allows their investments to grow in value without triggering a taxable event. And as long as they don't sell their investments, they pay no capital gains tax. This works great from a tax perspective because it allows you to control your taxes. If you don't need money, your investments can grow in value. And if you do need money, then you can sell your investments. And ideally, you will time your investment gains in a period where you are in the lowest capital gains bracket possible. For example, let's say you invested $500 per month in an index fund with a 10% rate of return. In 30 years, your investment would have grown to $1.2 million. And at that point, let's say you decide to retire and have no other income, but you need $80,000 per year to live. Well, at that point, you could sell $80,000 of your investment and pay 0% tax on it because you are now in the 0% tax bracket. On the other hand, if you had an $80,000 capital gain in a year where you are reporting $200,000 in earned income, you would pay $12,000 in capital gains taxes alone. So if you want to qualify for the 0% tax rate on your capital gains, timing your investment gains will be very important. So what do you think about this? Do you think you can realistically qualify for a 0% capital gains tax rate? Let me know your thoughts in the comments below. At a minimum, I personally believe that this will be very helpful for people who are thinking about retirement or approaching retirement so they can sell their investments and qualify for that 0% capital gains rate. And for others, I think this will be a great tool to have on your tool belt for years where you earn less money than you thought you would, or you're taking advantage of so many tax strategies that there is not much income reported on your tax return, which may lead you to take advantage of this 0% rate on your capital gains. If you want a tax plan that is guaranteed to help you save money in taxes, head on over to mycpacoach.com to apply to work with one of my CPAs today. And as always, thank you for watching.